Ladies and gentlemen, good day and welcome to HDFC Bank Limited Q3 FY26 earnings conference call on the financial results presented by the management of HDFC Bank. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Srinivasan Vaidyanathan, Chief Financial Officer, HDFC Bank. Thank you, and over to Mr. Vaidyanathan.
Okay, thank you. Good evening and a warm welcome to all the participants. As we begin to review our earnings for December quarter, I would like to briefly give an overview of the current macroeconomic environment, which overall was providing stable to positive operating environment. High frequency indicators suggest considerable improvement in consumption demand. Growth was also well supported by lower interest rates, higher government spending, front loading of exports to US, and sustained momentum in service exports. Looking at certain key high frequency indicators, Rabi sowing improved over prior year, aided by healthy water reservoir levels. Manufacturing PMI continued to remain in expansionary zone. Services witnessed broad-based recovery with improvement in air cargo and passenger port traffics. On the consumption side, demand indicators, both urban and rural, improved considerably. Overall retail sales increased primarily by higher passenger vehicle and tractor and improved demand for consumer durables. RBI, as you know, reduced policy rates further by 25 basis points in the December 25 policy review. The decision was driven by benign inflation outlook, positive growth outlook, supported by resilient domestic demand, even as external trade and policy uncertainty continue. The country's FY26 GDP growth is expected to be 7.4% consensus view, and that's also our house view. Durability of consumer demand pickup and sustained improvement in labor market conditions, especially on the urban side, would be critical to watch for to achieve continued recovery in economic growth. Now, turning on to certain key bank metrics. Overall credit growth build-up has been encouraging. We set our sights on balanced credit across various customer segments, which you saw in the recent quarter reported. Easing of rates and benign credit has provided catalyst for this credit growth. CRR release also enabled credit deployment slightly ahead of our expectations. Advances under management as of December end at rupees 29.5 trillion, 2.6 trillion or 9.8% higher than prior year. Similarly, on an average basis, 2.4 trillion or 9% over prior year. CD ratio as of end of December was at 98.7%. On the deposit side, the total deposits amounted to 28.6 trillion, grew 3 trillion rupees, 11.6% year on year. On an average basis, 12.2% growth year on year. Current account deposits at rupees 3 trillion grew by 324 billion or 12.1%. Savings deposits at rupees 6.6 trillion grew 561 billion rupees, 9.3% year on year. The term deposit aggregating to rupees 19 trillion grew 2.1 trillion or 12.3% year on year. Again, just to say the funding through deposits was underpinned by rate discipline. That has been a key underpinning there. Individual customer segments were seen to be strong. For both current account and savings account, having focused on granular segments have seen encouraging outcomes. On the distribution expansion side, we added 71 branches in the quarter, 161 branches year to date, and 473 branches in the last 12 months. Payment acceptance points at 5.7 million is about 6% higher than last year, and with the rural presence of about 2.5 lakh villages covered. In the customer franchise building that enabled us to add about 1.5 million new liability relationships in the quarter, our customer base stands at about 100.4 million customers. On cards, we issued 1.4 million cards in the quarter. Total cards stands at 25.4 million. The balance sheet remains resilient. LCR for the quarter was 116%. Capital adequacy ratio, total capital adequacy ratio was 19.9% and CET1 at 17.4%. Now turning to some of the P&L categories and metrics around that. Net revenues for the quarter were at rupees 459 billion, grew 8.9% over prior year. Net interest income for the quarter at rupees 326 billion, which 71% of net revenues, grew by 6.4%. The core net interest margin for the quarter was at 3.35% against 3.27% in prior quarter. On an interest earning asset basis, the core net interest margin was at 3.51 against 3.44 in prior quarter. Other income was at rupees 133 billion, grew 15.7% versus prior year. Fees and commission at 92 billion rupees, grew by 12.8%, and contributed again, the other contributors of other income, FX and derivatives income at rupees 14.3 billion, was higher by 2% compared to prior year. Net trading mark to market was rupees 9 billion against 24 billion in prior quarter. Miscellaneous income at 17 billion includes recoveries from return of accounts and dividends from subsidiaries. Then getting to the operating expenses for the quarter was at 188 billion. Operating expenses, excluding the estimated impact of rupees 8 billion for employee benefits under the new labor code, were at 180 billion and in rupees 180 billion, an increase of 5.1% over prior year and flat to prior quarter. The core cost to income ratio, that is the cost to income ratio excluding this one-time employee benefits under the new labor code, was at 39.2%. This should be looked at in the context of the branches additions I had mentioned too. The GNPA ratio was at 1.24% compared to 1.24% in prior quarter and 1.42% in prior year. The GNPA ratio, excluding the NPAs in the agricultural segments, which have seasonal impact in the quarter of December and the quarter of June, and now the December quarter impact, excluding the agriculture segment, was at 0.97%. Prior quarter was at 0.99, and prior year was 1.19. The net NPA ratio was 0.42, flat to prior quarter. Getting to the slippage for the quarter, 29 basis points, and about as against 25 basis points in the prior quarter. Again, impact of agri. Excluding agri, it was 24 basis points compared to 23 basis points in prior quarter. That's on the slippages. Now turning to the provisions, the total provisions charged were around 28 billion after release of contingent provisions of 10 billion, primarily in respect of large borrower group fulfilling certain conditions. Then getting to the provision coverage ratio was 66. Provision coverage ratio excluding agricultural segment was at 70. The annualized credit cost for the quarter, excluding the release of the provisions I mentioned due to fulfillment of certain conditions, was at 55 basis points. Prior quarter was at 51 basis points. Recoveries were about 13 basis points against 14 basis points in prior quarter. Net profit after tax for the quarter was rupees 187 billion, grew by 11.5% over prior year. In summary, the results were driven by a robust team of 216,000 employees, serving about 100 million customers, delivering profit after tax, I mentioned to you, of 187 billion, 11.5% or up over prior year, delivering return on asset in the quarter of 1.9% and return on equity of 13.9%. And earnings per share in the quarter was 12.1 on a standalone basis. Book value per share on a standalone basis is 352.6 rupees, and at consolidated bank level at 367.1. And with that, may I request the operator to open up the line for questions, please? Thank you.
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Please note, participants are requested to restrict to 2 questions per participant and kindly join the queue for a follow-up question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Ritu Singh from CNBC TV18. Please go ahead.
Mr. Vaidyanathan, thanks very much for taking our question. The bank has said it wants to grow loans above the system level in FY27, but as of your latest numbers, your loan growth is close to 12%, deposits close to 11.5%, and therefore this LDR ratio is climbed to almost 99%, 98.5%. Now, given deposits across the system are just growing in single digits, if you could tell us how realistic this above system loan growth without operating at a structurally high LDR of 95% plus is going to be possible, and then I'll follow back with the other question.
Okay, thank you. Good evening. Let's talk. The CD ratio is an important focus for sustainable profitability. Right? We do want to keep directionally moving that lower. That's the objective. We want to progressively move it down. There are quarters. Quarterly numbers is not something both the seasonality and also market reality in terms of liquidity and so on can have a variation to that. Right? We are in an easing cycle with credit growth focus in the country that also needs our participation. Okay, the speed of that movement depends on available funding, as I said, and also one other dimension that we work through is rational rates. The rates have to be rational, and we work through that also. I'd like to say that in the current scenario, we don't think that we are constrained by that as a CD ratio, because we know that directionally we are working towards moving it down. Quarter to quarter, moving up or down is perfectly fine. But when you look at an annual basis, the objective is to keep moving it down as we go along. So we are confident that it will be on a downward glide path. Having said that,
does that mean, Mr. Vaidyanathan, that in this cycle, based on your comments, loan growth effectively takes priority over bringing LDR back to your historical comfort levels, and therefore should investors also recalibrate their expectations on how quickly the bank can move closer to this sub 90% LDR, which is the target?
Okay, yeah. See, we want to get to that around that level. So the objective of wanting to move down does not change. Quarter to quarter variations happen. The glide path will be dependent upon how market availability of funding and rational rates behave. Again, as I said, we are confident that there is adequate level of distribution strength, people engagement that we have to get the deposit growth to suit that and to fund that loan growth. And that's the direction we have set, and certainly not focusing on quarter to quarter. Yeah.
So margins at 3.51% are actually higher, compared to what the street is factoring in. Given that there is an expectation of perhaps one more rate cut from RBI, if you could give us a sense of when you can get back to the historical 4% kind of levels, whether you see some further hit, and whether at all, you're considering cutting the saving account rates, which some of the other banks have done in this quarter.
Okay, yeah, no, good point on that. See, I don't want to get to one number as such or give an outlook of a number, but I will directionally talk, right? Which is there are three factors that have the margin, and leave the rate to the side. I will come in the end. Policy rates to the side. I'll come that to the end. One aspect of the margin movement is the cost of funds, and within the cost of funds, the TD repricing always lags the asset repricing. As the policy rate have moved 125 basis points, the first 100 basis points is for all purposes factored in actuals. The last of the 25 basis points that happened in the first week of December, for some of that is factored in the December quarter. Some of that between 1 to 3 months it starts to flow in at the repricing cycle. So some will come. then what the time deposit repricing is almost between 4 or 5 quarters lag, because one, we changed the rates. We have so far changed about approximately 80 basis points we have changed out of the 125 basis points policy rate change. Even that flowing through takes 4 or 5 quarters, because on the renewal of those deposits, that's when it starts to, that 80 basis points starts to factor in. So that's one important driver for cost of funds. In this quarter, you saw that the cost of funds moved down by about 10, 11 basis points or so. It came down in this quarter. And similarly, we do expect that with the policy rate changing, if it does change once more, then there will be a lead effect of the asset repricing faster, and then the deposit pricing will lag that. So that is one on time deposit repricing. The second aspect of that is CASA. As the rate starts to go down, then the reversion of customer preference towards or indifference point between time deposit and savings at some point in time, which we have empirically seen over the last 2 cycles, over the last 15 years, is that there will be more propensity for for savings accounts to pick up. And so that is another important lever that we have in that. And the third is the borrowing. We do have borrowings, which are 13% of our liability mix. Typically, we have run with about 7% or so. And similarly, if you look at the system, industry as a whole is also about 6-7%. Given that as the maturity happens over the next few years, we do expect to realize the differential between the borrowing cost and the deposit cost. So these 3 kind of elements are there embedded in the cost of funds to realize over time. That's where the margin movement happens and the cost of funds gets lower. And wherever the rate changes again lower, then this pushes by a quarter, because what happens is that the assets come in faster and the deposits take a little more lag time.
Thank you very much. Ritu Singh, I'll request you to kindly come back for a follow-up question.
After this break.
Thank you.
Thank you. A kind request to all the participants, kindly restrict to 2 questions and rejoin the queue for a follow-up question. Next question is from line of Piyush Shukla from the Hindu Business Line. Please go ahead.
Yeah, good evening, sir. Sir, following on to Ritu's queries on CD ratio, you had mentioned a glide path is there to bring down to the pre-merger level, which is around 90% odd. I just want to understand by when can that happen? Will it take another 1.5 years for the CD ratio to go down to that level? And in that regard itself, will you be looking at securitization? I'm not aware if you did any securitization in Q3. Also, in terms of branches, will you add more branches? Because you had mentioned earlier that each year, 1,500 sort of branches will add. But if we see from March till December this year, you've added around 161 as per your branch network investor presentation slide. So what are you doing to lower the CD ratio? By when will it come down to the traditional around 90% mark? And second is, you mentioned the various factors which will play out in determining the NIM over a period of time. Just directionally, by the year end or by the next fiscal, directionally, sir, will it be upwards or will it be stagnant, considering all the factors that are at play?
Okay, yeah. See, again, there's nothing more to add for me on the CD ratio than to say that the glide path that we work on is to keep moving that down. The timing of how fast it can move, certainly we're not focused to get that quarter to quarter, because you know that there are lots of seasonalities in the country that operates. So quarter to quarter things don't work like that. But an annual basis movement in that direction is what we have as a glide path objective. We'll work on that. And again, the quantum is again dependent upon the market rate of growth, right? Because we do want to participate in the credit of the country, and it's very important from overall economic growth. And so, while in this year we had envisaged to grow in line with system, that is what you are seeing, and in the following year to grow faster than the system. So that remains there. As far as the margin is concerned, again, not one number, but yes, the levers that I mentioned about the cost of funds being an important lever, the three elements of the cost of funds that are an important lever, continues to be there. And to the extent that the asset pricing, 70% of the assets are linked to external benchmark. If the external benchmark do not change, then this quarter sees certain amounts of December pricing factored in fully. Then after that, it is the cost of funds that needs to flow in, right? And I won't venture to give one number because that's not how we don't give an outlook as such on that. I hope that branches, you talked about branches. See, 1,500 branches is something that we did in 1 year, which is in the year March 23. That financial year is when we did. You have to look at a context of how we did branches. So you have to go back a few years. So if you look at the year 2019, about 250 branches, 2020, about 350 branches, and then we kept moving that. So 22 we hit 750, all round numbers. 23 we did 1,500. 24 financial year we did 900. 25 financial year we did 700. And so you can see that 250, 350, 750, 1500, 900, 700, how that curve was moving, right? When there was an opportunity space in our investment profile, we used that to make those expansion rapidly because we wanted to get through the maturity cycle, which takes about 2 years to 3 years to break even. And it reaches a kind of a peak maturity by reasonable maturity to start contributing significantly by year 5. So that is the reason that we went through that process to do. Having said that, currently we do envisage to keep adding branches because at the end of the day, we do have only 6% of the country's branch system share that we have. Our 9,600 branches are approximately 6% of the country's branch system. So our branches are extremely productive. If you look at the branch per branch deposit, about 305 crores, you will see that it is best in class, right? And it keeps growing. Despite the branch additions, if you go back, it was 120 something, 125 something 5-6 years ago, right? Per branch. So despite the branch additions, the per branch deposits keeps going up rapidly. And there will be a point where it starts to stagnate, at which we will evaluate. But certainly, we don't see it in near term that it can stagnate because we do have only 6.5% or so market share of distribution. Securitization, something that you touched upon. Yeah, there was a modest level of securitization. And again, we have told you about the strategic objective of securitization. We do think that it is a long-term objective to ensure that we have a good kind of a market availability for securitization, and that is why we nurtured and cultivated this over the last 2 years. We have done about 60,000 crores or so over the last 2+ years we have done, and as and when opportunity arises, we do. You know that these are larger ticket transactions that take place. We started this to align the process of rating agencies, the evaluation, the MIS process of reporting. All of this was supposed to be kind of ironed out, which has happened. Now, at every we need strategic investors for these, right? And the India bond market, the GSEC market got opened up in the JP Morgan Bond Index. That was an important initiative 2 years ago. And then as and when the private bonds and others enter, we do expect not only domestic participation, but also foreign institution participation in the fixed income market. And that is where we are positioned to take advantage of that as we go along. It remains a strategic objective, but certainly, again, we are not focused on just lightening the balance sheet just like that for the purpose of managing this. So we want it to be strategic.
Thank you. Piyush Shukla, I'll request you to come back for a follow-up question. The next question is from line of Shubhna Sheikh from Mint. Please go ahead.
Hi, sir. Good evening.
Good evening.
Sir, I understand you haven't given any guidance on margins, but just wanted to understand what are your rate cut expectations? Are you expecting a rate cut next month? And Do you expect the pressure on margins to continue in Q4? You said that half of the impact you've seen in this quarter from the last 25 basis point rate cut that we saw. So you expect some pressure of that to follow through in Q4. Second, sir, I wanted to touch upon retail growth, retail loan growth. That has been steadily declining, on a year-on-year basis that we have seen so far in this financial year. Has the GST impact, to what extent has that helped? And you said that you would grow your loan growth, deposit growth in line with industry. Has your loan growth and deposit growth target changed in any manner? And if that has, if you could share the number with us.
No, nothing has changed. We do expect and we are positioned to grow in the next financial year faster than the system. As far as the retail loans are concerned, there are two large categories you can think about. One is the mortgage and one is the retail assets, excluding the mortgage. When you look at the book growth, you see that in the high single digits. However, when you look at the disbursals are quite strong. The mortgage disbursals are about 9% or so growth year on year. Again, you know that it is market dependent, home availability and also the funding needs. There are segments which don't need the high-end segment, which is the top tier cities, which are patronized by the ultra net worth, high net worth people. The funding needs, the loan needs for such home funding is very limited to some extent. If anything, it is a transitional funding. The mid-market, the core middle class, which is our big customer segment, that is where we are quite keen. And you know that the price competition is extremely high in that area. Despite that, we have one of the highest market shares, and the disbursals have grown faster than the book, which is very important. Because we are not marketing a mortgage product, we are offering a customer relationship with mortgage product as the fulcrum there. So that is very important, which means opening up a savings accounts. We are successful in 99% of the cases to have savings account when we give mortgages. We have a penetration right now of about 14-15% to offer credit to give credit cards to customers who take mortgages. Similarly, a brokerage account is 16% or so. So like that, there are multiple products, 8 such products, and so we want to offer the whole bouquet of the bank to develop that relationship. That's when you get the best of the customer here. So which is what we are focused on. So disbursals is the lead, and that is picking up. The book is a lag, and that starts to build because such a large book, the pay downs are quite high. Pay downs means the monthly installments, while 15 to 20 years is the contractual. People normally tend to pay approximately in 7 years. On an average, you see that it pays down in 7 years. So that's the pay downs happen, but the disbursals are quite strong. So now come to retail assets, which is non-mortgage retail assets. Again, the disbursals are quite strong in the double digits, but the book build takes lag because you know that these retail assets are 2 years, 3 years, sometimes 4, but on an average between 2 and 3 years. And so when you look at the book size, the pay downs are so fast that the disbursals have to be multiple times taken up. So which is already picking up on the disbursals. So we'll have to wait for that to come and lap the rate and get on to the historical rates that we have had.
Thank you. Next question is from Siddhi Naik from Bloomberg. Please go ahead.
Hi, sir. Am I audible?
Yes, please.
Hi. So firstly, I have 2 questions, but I'll start off with a clarification first. You say that your CD ratio eventually will go lower and that you also want to grow your loans faster next year compared to the industry. Now, are we to assume that effectively you will be growing your deposits faster than loans consistently? Because and how would you do that? Because we are in a low interest rate environment now.
No, that is correct in terms of deposit faster than loan is the way. But certainly don't look at it quarter to quarter. because that is something that there are seasonalities that play. But then when you look at annually, when you look at multiple years, you do that. Then your question very important in terms of how do you get that? How do you get to this, right? So that goes to the fundamental premise of our retail branch banking strategy itself, right? Distribution is an important strength. That is why we keep adding. And the maturity of the distribution, it gets to 2-3 years to break even. It reaches a reasonable scale at 5 years. And then it starts to geometrically multiply. Once it goes between 5 and 10 years, it is 3 times more than what it does in the first 5 years. When it crosses the 10-year mark, it does almost 10 times more. And we are reaching several of those thresholds of the maturity cycle. If you look at the branch build that we have done over a decade, there are a bunch of them that are entering into that 5-year above bucket. There are a bunch of them entering the 10-year and above bucket. And so that's very important from the maturity model on the branches as such. So that's the distribution is the strength. And that is why we also keep looking at the branch productivity, which is what is the per branch. The 305 crores per branch is the best in class and the most superior productivity that you will see. That's one. The second, apart from that, is also going through offering the holistic product suites to the customer. So while we do a lending kind of a product, a PL, an auto, a credit card. So I give you credit card as an example. A customer having a credit card with us, we are the market leaders on credit card, 25 million cards, last quarter 1.4 million new cards issued, right, with a spend market share of about 29%, and a card in force market share of 22-23% or so. 100 odd million cards in the country, we have about 25 million cards or so. What does it do to us? For every 100 of a credit card balance outstanding in the statement, the deposit that are kept at an aggregate level, right, aggregate of all the customers, is more than 5.5 times. So that means the more the card customers, more the card spending that happens in their card, more the balances come in here. So that's part of how we operate. And similarly, in mortgages, I was alluding to in the prior question, that we are not offering just a vanilla mortgage product. We want a customer relationship with the mortgage as an important product offering. That is how we have taken it to a 99% right now for mortgage customers opening a savings account. And then at the inception, that means at the time of opening that, the balances that build in there is about 35,000 rupees. And then when you look at 12 months, 18 months on book, when you go back to see what are the customers who booked 12 months ago, 18 months ago, and look at that, that balance builds to 2.5x. And typically we have seen over a long customer vintage that it can be 5 times more than a normal customer who does not have a mortgage, right? That means a mortgage customer savings, the deposit balances could be more than 5 times deposit balances of a non-mortgage customer. So the holistic marketing and getting the holistic product suites through our branches is very important from that. So that's the kind of the turnaround time and several of these differentiation we do. That's where and we are adding new customers. I just alluded to saying we added approximately 1.5 million new liability relationships in the quarter, to taking it to some 100 million, 100.4 million customers that we are working with. So that bringing on new customers, bringing in new account value. So that means they don't have relationships, they don't have balances. So anything they bring is a new account value. And then the customer maturity takes 3 odd years. So that means when the customer comes in with some balance, that itself is an accretion to the bank, deposit accretion. And then as time goes by, that starts to multiply. And it starts to peak in 3 years where we say customer is now fully mature in terms of making this a primary bank, making this a good bank where everybody has got multiple bank accounts, right? And so our bank becomes a good bank with balances that we can call it as a matured at that kind of a stage. And then the second thing is the change in balances. Change in balances is existing customers, work with them to bring in more, that is through an asset cross-sell, so you get multiple balances. And you also have investment and insurance products where those kind of a savings-related products also encourage balance build-up before it goes there, goes into mutual funds and insurance. So broad-basing these kind of both customer engagement, we have about 18 million customers with whom we engage through various segmentation of the customers from private bank to Imperial to preferred classic, virtual and so on. So segment the customers and accordingly the engagement model is different for different customer segmentation so that we can get the best out of them. So these are some of those approaches to what you had asked about how do you get the deposits. This is how we work towards getting those deposits.
Thank you. Siddhi Naik, in the interest of time, I'll request you to please come back for a follow-up question. Next question is from none of Hamsini Karthik from Money Control. Please go ahead.
Hi.
Hi, good evening.
Good evening, sir. How are you?
Doing good. Thank you very much.
Yeah. Happy New Year. So couple of questions, sir. Last year, around the same time, you said that FY26 would be a year of normalization and growth, which has happened, and FY27 is when you will grow ahead of the market. We look forward to it. But your commentary in terms of margins, where it was promising somewhere that, you will not, HDFC as a bank will not give up on its 4% margin aspiration, somewhat seems to be sort of difficult to, it's not easy to project that in the near future. Is 3.3 or 3% nearby margin a new normal that you're contented with at the bank?
A very important point that you raised. Thank you. Same time last year, when you look at it, the rate cycle had not kicked in. The rate cycle started to kick in from around the from around the February 25 time period. That is when the easing of the rate cycle started. So that's important. So when you look at our yield on assets was 8.3% around that time period. Today, when we reported, our yield on assets is 7.8%. 50 basis points lower it has come. And these are market-linked deposits, right? Market-linked loans, right? External benchmark loans. Where the policy rate changes, these change. About 70% of our loans are external benchmark loans. So that is part of how we have to live with it. The second thing, then you respond through deposits, right? Deposit pricing, borrowing pricing, a mix of borrowings to deposits. These are the levers that you do to operate. During the same time period, the cost of funds, 4.9 at that time, today it is 4.5. Okay, so 40 basis points. So that is why when you look at year to year, there is about approximately 8 or 10 basis points you can say is lower because there's a lag effect of the cost of funds. Cost of funds has not fully come through into the cost of funds yet because the time deposit repricing takes this time. Right? The savings account rate change that we did instantly came in through. Time deposit will take another few quarters to come. And so, if the rates remain steady, you should expect that the cost of funds benefit starts to flow through, and the yield can be steady. Right? That's we need to work through what happens when the rate changes. That is one. Second thing is that even on the deposit side, while policy rates of 125 basis points is factored in the yields on assets for most part, other than the fully pricing in the December cut, on the cost of funds, we have changed the time deposit rates by about 80 basis points so far. Right? That's in line with what the market has done. We look at the competitive situation in terms of deposit pricing. We see about 80 basis points or so far factored in. So more to come from there. So yes, coming back to your original premise question of the bank's aspirations for the margin remain. I just described about 10-15 minutes ago to another person that the three elements of the cost of funds change continue to be valid and remain as an opportunity space to realize.
Great. So my second question is with respect to Mr. Bhavesh Zaveri taking a call that he will step down from the board. You may appreciate that as the year started, there were allegations around a few related party transactions, which could have possibly resulted in him taking a decision of this sort. Lately, sir, especially in the last 1 year, we are in public domain beginning to read, and people taking to social media read a lot about governance-related issues at HDFC Bank. I'd like to understand how much of it is, what is the bank doing to ensure that these sort of questions are not put forth on the bank? A little on your governance-related framework, and how strict or what are the policies with respect to RPT? If there is an RPT, would you allow that transaction to go through? Is a mere disclosure enough to the board, or should there be a termination of the contract as well?
Okay. See, Bhavesh Jhaveri, as you know, is the executive director, and he was appointed in April of 2023 for a 3-year term as approved by RBI. Then, as of this moment, it is his personal choice where he's indicated not to seek reappointment. Okay, so that is something that you need to keep in mind. I do not want to speculate about the reasons and so on. And the last item we talked about governance. I mean, I will restrict it to only one sentence rather than going into detail. If you look at our ESG disclosures we have done, we have the highest governance score of 1 by ISS in 2025 on governance, which is published on page number 28 in our investor deck. If you look at it, we have that. I will restrict my comment to that, and because it's wanted to be focused on earnings than that. But since you raised it, I just want to bring your attention to the earnings deck itself, where we published that we are the highest rated. We have got the highest governance score of 1 by ISS in 2025.
Thank you very much. Hamsini Karthik, I'll request you to come back for a follow-up question. In the interest of time, we will take one more question. Next question is from line of Saloni Shukla from The Economic Times. Please go ahead.
Hello, sir. Good evening. So just sort of going back to the deposits. So this quarter, your deposits growth has been. Sir, can you hear me?
Yes, please.
Yes,
yes.
from your audible.
Yeah.
Please go ahead.
The deposits growth has been lower as compared to, couple of past quarters where you have had really phenomenal growth. CASA growth is also lower. So from here on, considering that the LDR has again jumped back to around 98% levels, how would you then mix this strategy? Is deposit going to be like CASA? Is there a pressure on CASA, and how will you balance all of this?
Time to time, do a lot of calibration and work through it. That is why quarterly we don't look at that seriously, because annual is what very important it is. But having said that, I do want to point out that even in this quarter, our rate of deposit growth outpaces the system rate of growth, where we gained market share. Similarly, on CASA, if you look at it, about 10% or so CASA rate of growth is also faster than the system CASA growth, where we gained market share. That's I want to leave the thought with you. The second thing that there are certain, I did describe in my opening comments, that the funding through deposits has been underpinned through the rate discipline, which is very important and key, right? If you look at our retail deposit rates, they're more or less in sync with our peer groups and market kind of standards. The non-retail deposits have seen enormous volatility in price, and particularly kind of a high competition from certain institutions, which we try to avoid and not work through it, right? However, when you look at the core customer segments, the individual customer segments operated out of the branches, the granular level of deposits is quite happy and feel strong about that growth. All right, so I do want to, and the recent even growth of the CASA, the CA and the SA, if you see that, has been very encouraging outcomes on that. So we're confident of building further on this, but certainly I would urge you not to look at quarter to quarter, because that's not how we are managing.
So would you stick to that you want to grow ahead of market?
That is right. That's right. Yeah, that's what I alluded to in the beginning. Yes, we continue to be optimistic and confident that is where we are driving to.
Thank you very much. Ladies and gentlemen, we have come to an end of the allotted time for this call. I would now like to hand the conference over to Mr. Vaidyanathan for closing comments.
Okay. Thank you, Nirav, and thank you all the participants. But some of you may still have questions or some not had the chance to get on the line. But we do have our corporate communications team open. Madhu and the team will be available. We would give you any other information or answer any other questions that you have in course of time. Please stay in touch with us. Thank you for joining today. Bye-bye.
Thank you very much. On behalf of HDFC Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.